Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone and welcome back to another episode of Blind Spots. We are doing part 2 of what to actually do when you retire. So if you haven't already listened to part 1, go ahead and listen to that first. We discussed all of the tangible items that you need to have on your to-do list as you approach your retirement date. But in today's episode, we are going to be discussing the transition period from working to retirement and all the logistics of transitioning to retirement that need to be done as you reach that very important date.
So first, a shout out to Erin's home state of Florida, the first state in the union to mandate personal finance is offered in high school. So Florida gets a lot of stuff wrong, but this is right. So kudos to the state of Florida.
I was a key activist in that legislation, so very exciting.
That's cool.
Just kidding.
We're going to go down kind of the, we're going to take on a persona of someone that finally retires, their first day of retirement. And it's going to be broken down in soft things that you should think about and do that aren't always obvious. It's not talked about all the time, but we think are important based on our work with clients. And then the logistics, how you actually organize your retirement to simplify, make everything seamless and stress-free so you can check out and enjoy the fruits of your labor.
Let's get into it. So we said that this is like the transition period, but we have celebrate as the first thing. So,
well, I think any good milestone deserves a celebration, pop a bottle. Erin, if you are like fast forward to when you retire, what's your beverage of choice, your first post-retirement drink?
Man, that's a toughie. I feel like it's going to be wildly different from what it is now, but I don't know.
I tend to associate
yours. I really can't think of what like a good, like what would be worthy retirement.
I mean, I'm not a champagne guy. I'm not a wine guy, but champagne has to be there, right? Like a good champagne, not like the crappy stuff.
I guess. I mean, I'm not much of a champagne drinker either, so.
I feel like champagne gives you just the worst hangovers ever.
Very heavy in sugar.
That's why then. Okay, so maybe don't drink champagne.
Maybe just a cold beer, like nice IPA. Yeah.
Sure. So drink your beverage of choice, and then we'll get into some serious stuff. So the biggest thing that people overlook, and they don't even really think about this, and I've talked about this in past blogs, is the mindset shift, right? If you think about your career, you've grinded your whole life, saving, investing, taking risks with small amounts of capital in the hope of funding a retirement. And it seemed like a lifetime off, or a lifetime out, I should say. Okay, that's the building wealth mindset. And you've spent your majority of your adult life, the majority of your career in this wealth building, risk-seeking mindset. And that's great. Once you retire, that mindset needs to shift from seeking wealth to being content and keeping wealth. And that sounds like a simple thing. It is a simple thing, but it's a very subtle and impactful shift. And keeping wealth mindset is completely different. You have bigger amounts of capital. You should take smaller risks with. You shouldn't take a risk where the best case outcome will not change your life, but the worst case would send you back to work. No, just so being more measured, being more calculated, being more prudent, being more skeptical. That doesn't mean you're a pessimist and you're in a closet and you're predicting doom. It just means being mindful of your risk exposures, being mindful of mitigating your risk of ruin.
What kind of activities or things do you hear from people who have not made that mindset shift, but definitely need to?
Oh, they think they need to be invested in 100% equities. They think they need to squeeze out every ounce of return regardless of risk. A lot of that is coming off the last 10 years of really good market returns. They're still in this building mindset, and it could manifest itself in odd ways. It could be shunning a safe asset class. It could be taking on debt when you don't need to. It could be buying a second home when it stresses the financial plan. It could be investing in a business. It could be gifting money to your kids. It can show up in various ways, but doing that stuff, making bets where the worst case could really adversely affect your plan, shows me that someone is still in that wealth building mindset. They need to turn that off.
Yeah.
I mean, at the end of the day, look, like we're all not going to be a Jeff Bezos. We're all not going to be the richest person on earth. At some point, you need to be content with what you built. And that's all I'm talking about is pumping the brakes a little bit and being happy and content with what you have.
Yeah, that's good. It's very important. And we have an entire podcast episode on the mindset shift from working to retirement. So if you're interested in hearing a deeper dive on that subject, check it out. Okay, how about daily activities and the identity struggle that we often see retirees having?
Why don't you share the anecdote that you did with me about a worker in Greece or a retiree in Greece and someone in America, because I think it hits it on the head.
Yeah, so I saw an interview or a video of someone similar to my age. She's just working. I think she's in marketing or something. And she worked with a boss who was from Greece. And she said the biggest lesson that she learned from him was when he said the biggest difference between talking to someone who is from Greece or talking to someone who's from America is when you ask a Greek person, what do you do? They'll often spout out a few things like, I'm a gardener, or I'm a runner, or whatever number of activities that they enjoy doing. But if you ask someone from America, what do you do? It's often your vocation. It's your job title. And I think that in America especially, our jobs are embedded into our identity. We become who we are as a working person. And that is often a struggle that retirees have, is because when you retire that job title. What's left is someone who you don't really know. You're unfamiliar with just that empty space. And so that's a conversation that we often have with clients is, once you retire, what are you going to do? What are you filling your time with? It's a big gap that people don't know how to fill.
Yeah. And look, Greece has its own problems. America has its own problems. I think a good mix is a blend. But this happened with my father, and I'm not throwing him under the bus. My dad was a software troubleshooter, software engineer. And he loved his job. He loved coding. He loved finding problems in code. And when it came time to retire, he couldn't turn it off. He couldn't fill that void. That's all he knew. That's all he wanted to do. So we actually kept working. But at some point, Father Time is undefeated, and we all have to hang up the shoes at some point in time. And when he finally did, there still was this void, and he actually consulted for a while. And now I think he's in a good spot where he has his grandkids. He likes to fish. And so he's kind of found his new identity, so to speak, away from coding, away from work. But it was a very difficult thing for him to transition from his work identity to his new normal of retirement. And we see that not across the board with clients. We have some clients that peel out of the parking lot, are done working, and they have no problem filling that gap. For other people, it's much more difficult. So, Dad, if you're listening, which I know you never listen to this, I'm giving you knuckles. This is a good thing. I'm happy you found your spot. I'm not throwing you under the bus, so don't be offended.
That's good. So how about routine and lifestyle? What are some things that, for the person who is a little bit lost, what are some ideas maybe to fill their time?
Oh, I've seen people that still want to produce, right? But they don't want to grind in their former profession. So they pursue a passion hobby. Like for me, I love to play golf. I could work at a golf course. I could be a marshal. I could work on the greens crew. That's a way for me to still produce and have a routine, but also I'm doing something that I like to be around. So find what interests you. And if you still want to work, if you still want to be social, that's a great place to start. If you have a passion hobby, like again, I always go back to golf for me. That's central to my retirement plan. So I know I want to live in a warm climate so I can play in January. But for you, it might be fishing, it might be volunteering, it might be spending more time with your grandkids, it might be coaching. I've seen clients go back and teach. So really, you just need to figure out what you're interested in, what you like to do, and do it. I mean, that could be sitting on a beach and reading. It could be something simple, or it could be something that is a little more advanced.
I think we often forget why we work. I mean, obviously it's to earn money and to live a lifestyle that you enjoy. But at some point that has to come to an end. And a lot of people are working so that they can one day retire. And it's just hard to flip that switch off. Like we forget why we're working.
Yeah. And it could be something as simple as not having that set routine anymore, right? Like when you're working, you're getting up at a certain time. You're taking the same commute to the office. You've got your work clothes. You've got your morning coffee. So all of these things, humans are habitual creatures. So just breaking that is a shock to the system for a lot of people. So being more intentional with your new routine, altering your sleep schedule, reading more, just carving out a more intentional routine can do a lot to ease the transition.
Yeah. Okay. I think that's enough on the transitional mindset. Let's get into the logistics, the things that you have to do, the things that are on your laundry list of to-dos as you transition to retirement. So tracking expenses.
So Erin, I think I asked you this last time, but you said something like 70% of people that we talk to don't know what they spend in retirement. I mean, is that close?
I think that's probably an estimate. I mean, I don't have real figures on that, but the majority for sure of people that we talk to could not give a clear answer, or maybe more like it is more of an accurate answer to what they spend.
Right. In the first year, since you're newly retired, it makes sense that you would not have a actual number to produce, right? So that's why we encourage people the first year that they retire, again, different habits, different behaviors, different activities, track your first year of expenses, because that'll serve as a really good proxy for the rest of your retirement. And know that your first year, you're probably going to spend more, you're going to be more active. Try to be aggressive on the expense side too. So when you're modeling your financial plan, if someone tells us that they spend $60,000 a year, we tend to massage that up to maybe 70 or 75,000 a year. So we want to be aggressive on what's going out the door, just to build in that margin of safety, which we'll get to a little bit later.
Yeah, it's great in the pre-retiree phase to be tracking your expenses and estimate of what you spend. But like you said, your behaviors change, so your expenses are going to change along with it. So good exercise to do. And you have a note on here that says broke out of Alcatraz. I don't know what that means.
I got to be honest, Erin, I don't know what that means either.
Okay, we'll skip over it. Must not have been very important. All right, so next on the list after tracking expenses is deciding who is going to manage your finances.
This one's a bit tricky. It takes some self-awareness. And I think if you're being honest with yourself, you would know if you're equipped to manage the money, manage your financial plan yourself. What I found is only the retiree knows what it took to build that nest egg. And they know the sacrifice and the grind and the sweat equity that went into building their nest egg. And when you're that close to the money, it can be very emotional, which is probably the number one reason why people hire advisors, because they offer a unemotional, objective, third-party look at what you're doing, and they're a buffer between you and the money. So if you're prone to making emotional decisions, if you have blind spots, if you've acted poorly in previous sell-offs, or you're not comfortable running a financial plan, you don't understand taxes, you don't understand asset location, you don't understand where the money is going to come from when you actually retire, these are all signs that point to hiring an advisor. And the pushback that we get is, well, Nick, I don't want to pay a fee. Well, that's one part of it. You should find an independent fiduciary advisor that charges a reasonable fee, for one. But for two, what you can't quantify is the dollar amount if you're making these catastrophic mistakes. I mean, maybe if you're foregoing spending $8,000 a year to work with an advisor, but you're making $150,000 in mistakes or paying $5,000 more in taxes each year, like that's a bad trade. So again, it comes back to self-awareness. And I've got a few blogs that maybe we can link in the show notes that talk about the difference between a professional and an amateur investor, what every do-it-yourself investor should know. I mean, it certainly can be done. I don't want to make it seem like it's impossible for people to do this themselves, but it really is a time commitment. It really is a full-time job, and you need to be emotionally equipped to handle it.
Yeah, I think that's all really good. And we should probably do an episode on how to choose an advisor that is right for you.
Yeah, and the best way for me to describe what it's like to do it yourself or just to be an investor, this is an old pilot's quip that I've used in past blogs, but investing is hours and hours and hours of sheer boredom punctuated by moments of sheer terror. That sums it up nicely. So in the good times, it's easy. Like from 2009 to 2019, let's call it, it was very easy to be an investor. You created a lot of geniuses. A bull market creates a lot of geniuses. You know, when the stuff hits the fan like it did in 2020 up till now, it's much more difficult. And that's where it helps to have a measured professional investor at your side.
Yeah, that's good. Okay.
So once you decide whether you're a do-it-yourself investor or working with an advisor, it does help to roll your 401ks into IRA accounts, right? That simplifies the process. So in your 401k, you're restricted by the menu of funds offered in the plan. When you roll to an IRA, you have the entire universe opportunity set at your fingertips. You can invest in anything, which is a major benefit. Plus, when it comes to taking funds out of the portfolio, paying RMDs when you're 72, you've got to take money out of your IRA. Working with an employer 401k is a nightmare, especially if you have multiple, because each one's going to be different. If you consolidate your 3 old 401ks into one IRA, that makes the administration, the maintenance, the distributions, the RMDs, the management much more seamless and simple.
Yeah. Well, you essentially covered that. Do you want to move on to financial planning?
No, let's talk about the asset location too. So once you decide where your IRAs or whatever, your different retirement accounts are going to be and who they're going to be managed by, you need to understand there's a tax efficient way to build out your asset allocation, right? So let's assume I'm a 60-40 investor, 60% stocks and 40% bonds, okay? And let's say I have $1 million in a Roth account, $1 million in a traditional IRA account, and $1 million in a taxable account, an after-tax account. $1 million, $1 million, $1 million. And I'm using those nice round numbers for simplicity, okay? I'm a 60-40 investor. That doesn't mean I'm 60% stocks and 40% bonds across all 3 different accounts, my Roth, my traditional IRA, and my taxable, okay? The most tax efficient way to set this up, it's called asset location. I might be 100% equities, 100% stocks in my Roth account, right? Because you'll never pay taxes on that money again. It grows tax deferred. You take it out and it's tax free. I want assets that move and move higher, especially if I have 30 plus years to invest, right? Because that maximizes that tax free aspect. If I own bonds in there, that would not be smart because bonds really don't move higher. They're not supposed to really do anything but produce income. My IRA account might be a true 60-40, 60% stocks and 40% bonds. Makes complete sense. My taxable account might be 100% muni bonds or 100% tax-free bonds, okay? All the investment income that my taxable account is spinning off would be tax exempt to me at the federal level. Depending on what state you live, it might be taxable, it might not be taxable, okay? Where people get hung up is they do 60-40 across all those different accounts. They put like dividend paying stocks in their taxable accounts. Dividend paying stocks are a great investment factor that have worked a long time, extremely tax inefficient in a taxable account. There's no way for you to shelter dividends from taxes, okay? So just by moving where you own certain asset classes around and being very intentional with that, you can mitigate your tax drag. You can boost your after-tax returns without having an opinion on what the market does next. We call it taking the low-hanging fruit. It's a beautiful thing.
Yeah, and you did an entire video on this. So if you're more of a visual person and your brain feels a little bit like scrambled eggs, thinking about all the different accounts and the allocation in each, it's a really great video to watch. So we will link that as well.
So I'll take a step back here. Everything that we do at Pure, everything that we talk about is focusing internally, focusing on the low-hanging fruit, the things that we can control. I can't tell you how many times I meet people and they're obsessed about what Russia is doing, what the Fed is doing, what inflation is doing, and they're paying some hack broker 2% a year. They own mutual funds in a taxable account. They're leaking oil on taxes. They're paying way too much in fees. They're getting horrible service. They're not doing financial planning. Their estate planning's a mess. And it's like, let's focus on the things that we can control. You can't control what Vladimir Putin does. It's fun to talk about, but you can't control what he does.
Mhm.
So give yourself a chance, folks.
Optimize the things you can control. That's our motto. Okay, so after you have figured out what your asset location is, then we will run a financial plan. And there's a lot of things that goes into the financial planning process, but this is especially important for the transition period as you're moving into retirement and after retirement to make sure that it all works out.
Yeah, so we're not going to dive into the planning side, but we're going to have some pointers here. So for one, when Erin says a financial plan, that's all of your income not tied to financial markets, like pensions or Social Security, your investable assets, any rental property, your primary home, your expenses, estimated tax rates, all of those different moving parts, along with your travel budget, the things that you would want to do in retirement. Maybe it's buy a second home. Maybe it's donate X amount to charity or the kids. So including everything that you would want to have happen, your ideal retirement. Okay. From that, we use the financial plan, one, to see if you're on track, meaning, can you do everything that you want to do without running out of money? Okay. Then we stress test it. So we say, what if the stuff hits the fan and inflation runs higher, or you spend 2 times more than we budgeted for, or we get a long period of lower returns? Like, how does that affect the plan? So that's the second thing. Third thing, we use the plan to make evidence-based decisions, right? Money's emotional, markets are emotional, the planning process can be emotional. We look to strip all that out. And let's say you come to me and say, hey, Nick, I want to buy a second home. Well, let's run the numbers. Okay. We'll run it in the context of your plan. We'll show you a scenario analysis at 300,000 second home, 500,000 second home, 800,000 second home. We can model the tax implications of that. We see how it fits with everything rather than making decisions in a silo. Mm-hmm. Okay. So in essence, use the plan to make evidence-based decisions. Your job, our job, is to make sure the inputs are correct. So each time that we meet with someone, we're obsessing about the inputs because planning is fluid. Your life's going to change. Markets are going to change. Let's focus on getting the inputs right so we can model a realistic scenario for it.
Yeah, and there's a lot of scenarios that are common between retirees that people want to see. A lot of them is like that second home, like you said earlier, gifting to charities or kids, maybe a Roth conversion, because everyone loves to talk about Roth conversions. So we want to see if that's a good decision for you or not, because it is not always. And then another big scenario that people like to obsess over is when to take Social Security. So we can run your plan with taking Social Security at 62 or your full retirement age or 70 and see what the best decision for you is.
Well, and the Social Security one is a hot button, and 99% of the time, someone has a theory on when to take Social Security, right? They could have heard it from their Aunt Bertha. They could have heard it off Twitter, but most people anchor to something that they believe in regards to when you should take the Social Security check or when to start taking that. Okay. Yeah. That's fine. It's not optimal. What I would encourage people to do is forget all that. Run taking it at 62 within your financial plan. Run 66, run 70, and see how it affects your asset base, see how it affects your cash flows, see how it affects your taxes, see how it affects your overall arc of your plan. And I don't know, Erin, if I can say this, but most times people agonize over this decision and it doesn't move the needle at the end of the day.
Yeah, I mean, the lifetime benefit could be potentially large between the different options, but one, it, depending on the person, doesn't usually make a big impact in your financial plan over your lifetime. And two, the biggest wild card is when you're going to die. I mean, that's the biggest wild card in financial planning in general, because if we knew that you're going to live to 150, that
plan is going to look wildly different than if you kick the bucket at 75, 5 years after you retire. So there's a lot of different factors, most of them being pretty unknown. So we try to make evidence-based, data-backed decisions.
Yeah, and it's like, okay, if Erin's going to live till 150, I'd say, Erin, take your Social Security at 70 and print the extra money for 80 years.
Yeah.
If Erin knew she was going to take a dirt nap at 63, I'd take Social Security now at 62. Well, knock on wood, Erin, I hope you live a long and fruitful life. But that's just an example to show you that even though we're taking into account all these things and making evidence-based decisions, there's still things we cannot know. Like, a lot of people ask me, hey, should I pay off my mortgage or invest the difference? Yada, yada. Can you run that over the next 3 years? It's like, well, so I have to assume a rate of return, and it just gets a little convoluted. But know that we do model that, and it could matter if you're using a long enough time horizon. So you can model that with some decent accuracy over 20 years. Anything shorter than that, like 3 or 5 years, it's probably a coin flip.
Yeah. All that to say, financial planning is an important piece of the puzzle.
And then the other part of the financial plan is, again, you've spent your whole life grinding, saving, working. Now it's time to take the funds out. And that's can be a little tricky because people aren't used to that. One, it doesn't feel natural. You've been a saver your whole life, and all of a sudden someone's telling you to spend money. That could be a little different. But there is a tax efficient, intentional way to draw down your portfolio assets. And in general, so this is just general advice for most people. It's going to depend on your tax bracket and where you live and all these other things. But from a portfolio manager standpoint, we can manage capital gains and realized capital gains and taxable investment income much more efficiently in a after-tax account, right? If I sell something at a gain in the month of February, I can sell something at a loss in the fall and wash it all away, okay? If I take something out of your IRA, pre-tax money comes out, it's taxable to you. I can't do anything. I'm stuck. So usually if someone has that after-tax pot of money, that's where we would fund the initial distributions. If you only have Roth or traditional IRA money, that's a different conversation, maybe beyond the scope of what we would do here. But for each scenario, we have a tax-efficient way for a retiree to get funds.
Okay, onward to more logistical things that you need to do after you retire. Next on the list, and it may be an obvious step, but for some it may not be, once you start taking those withdrawals from your account, it's got to go somewhere and it's got to come from somewhere. So setting up the link between your bank account and your retirement or investment accounts is an important step because sometimes it takes time to get all of that stuff set up. So if you need money right now, you have to be prepared for it.
Well, and so kind of piggybacking off of that, once we identify where the money is going to come from and you link your bank account to your investment account, a lot of people want to know how much they should be taking. And that's where the cash flow piece comes in, which I think, is a pillar of our financial planning process. Is we show people, again, income not tied to financial markets, right? Pensions, the Social Security, rental income, part-time employment, yada, yada, versus their expenses. If that number is negative, meaning your expenses are more than your income not tied to financial markets, that's your gap. That's what you need to fund. And when I say expenses, I'm including taxes in that. So basically outflows, expenses plus taxes, income not tied to financial markets. If there's a gap there, that's what you would need to fill with the investable assets. Some pitfalls where I see people end up making mistakes is they take more than the plan is telling them to take. So if the gap is $3,000 a month, meaning the plan is telling you need to take $3,000 from your investment portfolio, don't take 6, don't take 7, like that stresses the plan. I mean, if you have a large enough asset base, it won't matter, but we're talking about keeping you on the rails and optimizing the things that we can control. People anchor to weird things. And it's like, well, I want to take 7 because that's roughly what I made my last year of employment. It's like, well, that doesn't make any sense.
That's one of the biggest, mistakes that we see is that people want to see a withdrawal the same as what their salary was coming in, which I guess psychologically I see where people are coming from, but it's one of those things where you just have to look at the full financial picture, where all of your income is coming from every different source. But this also ties back into our conversation from part 1, where we talked about how people think that their income or taxes in retirement is going to be lower than what it was when they were working. And that's one of the main reasons that it stays the same, is that people continue to draw the same amount that it did while they were working. But if you think back again to the time when you were working, oftentimes you've got extra money that you are investing or you're saving on the side. And so you're not spending every single dime that you did when you were working. So that's why you don't need to continue to take out the same amount.
So we talk about planning, and I think it's important to have a robust plan that's up to date, that showcases your current lifestyle and reality. But if the last 2 years have taught us anything, is your plan is not going to go according to plan. Okay.
Mm-hmm.
So that's where we want to be aggressive on the expense side. We want to be conservative on the return assumptions. We want to build a shock absorber. We call it a margin of safety for when your plan does not go according to plan. Planning process is fluid. Things are going to change. Your life is going to change. Priorities are going to change. You're going to get bad market environments. You're going to get weird stuff happening. Our job is to bulletproof it. So no matter what happens, you still have money. You're still on the rails. You can stick to your investment program. You can stick to the financial plan and give yourself a high probability of success, of a successful outcome. So now we're going to talk a little bit about things people do that can increase their likelihood of a bad outcome. Probably the biggest one that I've seen, and this is more of a general thing, is we talk about scenario analysis and modeling these big financial decisions and then showing people how that impacts their plan. You would be surprised about how many people will just go ahead and do something and then want us to model it, right? So, I gave my nephew $500K to start a business. Can you go back and model that and see how that affects the plan? And it's like, well, that's defeats the purpose. You made an emotional decision, not backed by anything, and now you're asking us to make sure the plan still works. Well, the plan doesn't work. You just gifted away 25% of your assets. So use the plan to make decisions. Don't do small things that could implode your plan. Like, we have people that want to take out lines of credit to buy a second home. We have people with lines of credit against their portfolio that want to make these concentrated bets, these huge portfolio bets in like Tesla or some EV risky company. And it's like that is not sound practice. Okay. So you should be looking to simplify, to bulletproof, to shock absorb your plan, not create holes where if the economy softens, if the market tanks, you're basically ruined. And that's what all these seemingly small things can do. They add up to a increased risk of ruin, which is the opposite of what you want to do in retirement.
Yeah. So be proactive in running scenarios before you make a decision, and not retroactive and trying to fix the things that you have already done. So now we have come to our segment of the episode where we like to highlight bad actors in the industry to demonstrate that not all advisors are the same. So this week we've got a double whammy. It's kind of a fun one. The headline read, FINRA sidelines an ex-LPL broker who raised $815,000 for a tequila company that imploded. So not only are we dealing with the advisor who made a few mistakes, we also have the private equity of sorts investment who also went down because of the mistakes that they made.
If your financial advisor is soliciting you to invest in his company where he's an owner or he's involved, that is a major no-no and a major red flag.
It is. That didn't happen in this situation.
No, it didn't?
No. So he is not the owner of the tequila company. So he presented the idea of this tequila company to some of his clients and ended up raising over $800,000 for this tequila company. He had 16 years of experience, so in theory, he should know better, but he essentially just failed to receive approval to offer this to his clients. So that's where he really had a broken program, is that he didn't have approval from the investment advisor that he was working with to even offer this to his client.
So he was soliciting funds for an outside tequila company without LPL's approval, which is a big no-no.
Right.
Right. So
and he didn't have the disclosures of
right.
the type of compensation that he received, which is also another big no.
Right. So folks, advisors, so every quarter we have to disclose any outside business activity. Okay. So if I'm moonlighting at Nordstrom's part-time, I have to disclose that, which I'm not, but if I did, I would have to disclose that. Doing business with any client too is a no-no. Like raising capital for something that is not approved, maybe it's your buddy's business, so you don't have direct ownership, but it's your friend's business. That's a major no-no. So your advisor should not be asking you for money for these dodgy business deals that are under the table or that are hush-hush. And it doesn't, maybe it does, but I don't know if it implicitly says this guy was paid by the Tequila Company for raising funds. He probably was. So that's another conflict of interest, right? Like if you're soliciting funds for something that you're being compensated for, that's another huge red flag. So this guy, I don't know if he's in jail. He got a fine, but I mean, he probably should be barred 7 months. That's not. He got a
7-month suspension, but another firm is still holding his license, so he's still licensed to practice after his suspension. And then he got a $10,000 fine. But here's where I thought that it was a double whammy. Here's the kicker. So the Tequila Company ended up getting in trouble. I can't remember who it was by the SEC, or probably not, but he raised over $935,000 for this Tequila Company, and then ended up using $450 of it for personal things like food, entertainment. There's a few things listed there, but it was wired directly to his personal bank account.
So how did this guy only get 7 months? Like this is fraud. He's defrauding investors.
I was pretty shocked.
That's just weak. I mean, that's embarrassing. So that's embarrassing for financial services. This is why we have financial services, financial advisors have the worst reputation ever. And it's why a lot of people think financial advisors are scumbags, because stuff like this, it's like, this guy should be barred for life. He should be in jail. He defrauded people. He misled people. He did things behind his employer's back. And for LPL not to catch this, I mean, it's just egregious on all levels.
Yeah, pretty bad, but just another case that we're highlighting. So
folks, not all advisors are the same. So quit thinking that. That was true in 1985. It's not true now.
Yeah, big takeaway of the day. So we referenced a lot of different blogs, other podcasts, videos that we have done. So those will all be linked below, but we hope that you have learned a lot from our 2-part series on what to actually do when you retire. So thanks for listening, everyone. We'll see you in our next episode.